Hello, everybody. Welcome to an Options Income Blueprint, Options Income Weekly Live Report. It is July 11th, 2022 at 2 p.m. Eastern with Michael Schulman. My name is Emily Norris with Traders Reserve. Today, we'll be going over the market, last week's trades, as well as the anatomy of a trade, where we'll be taking a deeper dive into our winner with Crocs last week. If you have any questions, feel free to pop those in the Q&A box. We'll get to those once we've wrapped up. And we meet tomorrow, that is July 12th at 11 a.m. Eastern for our next Options Income Blueprint live trading session. With that, I'll let you take it away, Michael.
Thank you, Emily. That's a reminder, just to reinforce what Emily said. We have a trading session tomorrow at 11. Now, I know this is quote unquote what we call a monthly update for people who are new. We send out emails. A lot of people who are new come into these live sessions, which are not trading sessions. And before we even get started on that, the reason we were 5 minutes late is Emily and I was yelling, she was calm. We're going back and forth about the nature of tracking. And the point is this: if you are brand new, I'm just letting you know, please track everything you do. And I track and Emily tracks in 3 ways. Profits, losses, continuing open positions that we have rolled. And that's the simplest way. It's a percentage. And this is a trading service. It's not a portfolio management service. This is not a bundle of stocks, 20 stocks. These are my 20 favorite. This is what we're going to trade. It's how I keep myself in line and the service in line with how are we doing. Is it 9 out of 10? Is it 7 out of 10? The second, of course, is how much cash are we bringing in, which we're going to go over. And you need to do the same. So you need to do the same with, it doesn't matter whether you're getting a trade from me or not, or an investment from me or not. Please track, how am I doing? I made 15 trades in the last 7 weeks and 13 nailed it. Even if it was 2 pennies and you're profitable, hey, in this market, take it. The second is, of course, how much cash am I bringing in, which, as I said, we'll review it in a moment. And that's very, very important. And the third is something that I don't do, which everybody does, and they probably do it every day, which is how is my portfolio doing. So those are the 3 things you should keep in mind. So let's get to it. We had a good week. We put on trades, that were the equivalent of $8,000 in net capital for new positions. And because of the way the market has been and the way airlines have been trading, we closed out United Airlines with a tiny loss, $3. And it's important for those of you who've been with me for 10 years and happen to be dropping in because you have nothing else to do. Yes, I normally, in a different market or maybe even a different sector, I might have rolled that, and we could have generated another 30 or 40 or $50. But the bottom line is, this is not a market where I want to avoid little losses. I'll avoid big ones. And the other reason is, and I've said this many times, we are trading the airlines anecdotally. I don't want to trade Delta, United, Southwest, or American week by week by week by week, because I feel they're already showing significant softness in the 3rd quarter and certainly in the 4th quarter. And Crocs was a really neat trade, which is what we're going to break down in a couple of minutes. We were busy. As you know, a few weeks ago, with positions underwater, we shifted over to accepting shares and selling calls, because what's the primary objective here? And it's to generate cash. This is a cash and income service. This is not a day trading service, even though this was a quick trade. It was three trading days in Crocs. All I'm concerned about in a given week is, are we generating the kind of cash to hit our goals of a minimum of 0.5% of cash rate of return on capital? That cash rate of return on capital, of course, is different than your portfolio value. And you can see by accepting shares and rolling calls, we've significantly, dramatically increased the amount of cash coming in. So our goal is 0.5% a week, or 26% a year cash return on capital in a given year. And we did 37%. Last 2 weeks, because of some shifts in the way we're trading, we were below that 0.5% threshold. Before that, we were really knocking out our park on a cash basis. On a portfolio value basis, which I said I don't track, many of those positions are underwater, and they won't be if we keep on grinding away and generating that cash. So you can see how the calls have been contributing. The rolled trades, for those of you who are really unfamiliar, brand new, just stepped in, there's plenty of training material on the website. Roll means we've bought back a put or bought back a call, and we've pushed it out a week or pushed it out 2 weeks. Now, let's get to some fun stuff. There's a big question here, which is, are interest rates or the recession driving the market? And interest rates really are joined at the hip with concerns about inflation. Recession is joined at the hip with data concerning the jobs market and economic growth. And then you go to, there's a lot of geopolitical issues that are directly, indirectly, or theoretically not impacting the market at all. And what's the role of the individual investor in the market? The individual investor's role increased significantly during the pandemic from a 10 to 12% percentage of all trades. And that's stock market movement, not options movement. We went to between 16 and 20. A lot of it was the GameStop Robinhood nonsense. But a lot of it was because people were home, and the market after the crash was going up, and people hitched a ride on the market going up. Now we have nervous investors and traders, professionals, and they're now back to 85 to 90% of the market, and including the robots and algorithms that they have programmed, which really have been driving the market 3 days out of 5 at the open. And there's a darkening mood. It's the lowest ever recorded feeling in the United States of the country headed in the wrong way. Although when you take the survey and you break it down, the survey numbers are a lot better when it's a specific issue related to the economy. People are concerned about inflation, but jobs aren't an issue. Wage increases are not an issue. Supply chain issues are being involved. People's extended families and neighbors, when you look at things, they're doing all right. They're less concerned about healthcare between the ACA and more people being employed, et cetera, the expansion of Medicaid and so forth and so on. So it really is about non-economic issues, but that does affect the stock market. It's Ukraine, it's constant gun violence on television, it's the noise about primaries, noise about what the Supreme Court's been doing, all put it together. It's like a really intense set of nails scratching on a blackboard. That affects investors and traders, especially investors. And what's the difference? An investor's thinking long-term, that's what we do, and a trader trades short-term, which is what we do. We do both. But the foundation is an investment mentality, great company, great undervalued stock. Let's trade it. Doesn't work for a couple of weeks. We keep rolling it until we get it to where we want it to go. And then in addition to all that background noise affecting the psychology of people professionally engaged in the market are legit things like inflation, interest rate, and recession fears. And one point about recession before we get to Crocs: 3 kinds of a recession. There's the statistical recession, which we're probably going to be in. Great Britain is 2 quarters of negative GDP growth. There is, excuse me, there's a recession, which we haven't had in this country in a while. And that's when unemployment starts to go up. And that's really hard to imagine. I was in a medical facility today. Don't worry, I'm fine. Just happened to be in a medical facility today. And of course, I'm asking about the software and I'm asking about the equipment. But we were also, I heard someone say I have 6 leads and I have 12 appointments and they're short of staff. And they're out getting staff, and they were talking about, this is a big facility, and they were talking about they're going to limit hours to 42 hours a week, and they're going to do this and they're going to do that. And they've raised wages. So even in something like healthcare, which is a very secure industry because of the nature of demographics and government support for the industry, hiring is an issue. So I don't see a jobs recession. We will have a statistical recession. And then there is what the market is most concerned with, which is a profit recession. A profit recession means that profits stay flat or go down on a per share basis or as a percentage of, let's say, net income as a percentage of sales. And for 25 or 27, let's say 25, nice round number. For 25 years, the percentage of profits as a percentage of GDP went up. They didn't do sophisticated statistical collection. It's really started in the 1930s, but that's unbelievable. And those kind of profits support buying back shares and paying dividends, in addition to saying, hey, it's a really good company, let's invest in it, let's trade it. There became concerns right after Thanksgiving that what are called higher multiple stocks, they have a high price earnings multiple. That's when they started to sell off. And it was concerns about interest rates, inflation hitting economic activity and causing a profit recession, because a company like Amazon, which by the way just reported out, a statistical survey company pointed out they didn't grow their Prime base for the first time ever. It's the same as it was 6 months ago. Those companies are not going to give up market share. They're going to reduce their margins and accept a hit in profits in order to retain customers, because the most expensive thing you do for many companies is finding a customer. Speaking of which, let's talk about Crocs. And again, I want to thank Emily because of my personal experiences and her personal experiences, sort of a joint effort here in picking the company apart. So the trend is the new frugal and COVID-19. The new frugal is people spending more on certain things, but being frugal, not cheap, and really watching their money, but in a very intelligent and rational way. The stock, when you look at its price earnings multiple historically and right now, it's cheap compared to its historical price earnings multiple, and it's cheap compared to the S&P 500, because even post-pandemic, it's really, really growing in serious double digits. So the stock was crushed post-pandemic. Purposes of disclosure, we took a big loss on it about, it might have been February, I think, when we closed a position we've been in a while, because I saw the stock as not going anywhere for a significant period of time. And perhaps it would go significantly lower, which it did from when we closed it, because of this concern about a post-pandemic flattening out. It's very liquid and the premiums are gigantic. So take a look at the bottom line. It's the premiums are gigantic. You have a 1.4% absolute potential return in less than 2 weeks. And that's 48% annualized. We're shooting for 26. The typical new trade here in Options Income Blueprint, the threshold is 32% or more when we put one on. And that changes if we close it early. It goes up, depending upon what we pay. And that's for a strike price, 13% out of the money. I mean, these are compelling numbers, but remember, the foundation is the stock itself. So finding Crocs is an interesting story, because it starts a long time ago. When I bought them maybe 15 years ago, maybe more. There was a rumor the company might go under. I bought a whole bunch. I think some are still in my storage closet. And they've done fine, you know. And it came back on my radar a couple of years ago, and Emily's. I noticed that doctors and nurses wearing Crocs when I was in the hospital for knee surgery. Cool, right? Not the surgery. So I asked, and they said, well, sure. We each own at least 2 pairs, because we can throw them in the autoclave and get them sterilized, because there's always stuff either here or in the ER. Well, come COVID, everybody has to be that careful. Everybody's got to wear shoes that they sterilize every day. And I saw this, I started reading about it. I was very familiar with the product and so forth and so on. And then a member in the master's program piped up that they were giving them away in the Boston market to attract new healthcare professionals to buying them. And there's been a surge in teen popularity. I always say that kids, excuse me, we'll talk about teens, then we'll talk about kids. Look at the numbers, 38 in 2017 and now number 6. And that's a big deal, because teens spend money on clothes. Teens drive their parents spending money on clothes. And no parent can really argue with this. It's not the first arguments I heard from a neighbor's daughter many years ago. I want a pair of black patent leather combat boots, and I'm not kidding, for my high school graduation. It's a little bit different. And they're also great for kids playing at home, meaning with COVID, the kids are at home, they're in the backyard more, they're in the park more. And I'm going, well, I could do a $75 pair of Nikes or 2 to 3 pairs of Crocs, and I can wash them. And this was a picture I took in December of 2020. I went to an outlet mall, but I go to an outlet mall at least once a month anyway, but I wanted to see where people were spending money for Christmas. And 3 stores, Ralph Lauren, Crocs, and Nike. And you had to wait outside. There were controlled entrance because of the pandemic. And it was a real tell. And so, of course, I waited online. I asked a lot of questions. I nosed around, and everything that I thought was going on was going on. So you can take a look though, when the pandemic's over, Wall Street says, I'm out of here. Now, they're out of here because they assume the big pandemic boom is going to end. You know, life on the planet is going to end. It's going to be extinct. The shoes are going to be extinct. And so I'm being glib, but it's totally crushed. Well, take a look at the quarterly numbers. Oh my, look at that. You're looking at, yes, there was a dip because the 9/30 number, 9/30/2021 in this top row is back to school and people outdoors in the summertime. And here you start seeing the real big downturn, the huge downturn in hospital visits and people leaving the healthcare industry, et cetera, and they're coming back. And here we have Christmas, post-Christmas, back to school. Again, back to school is 90% of the interest is in July and August, but there's also some back to school in January. And you can see that operating income was going down because they weren't giving up market share. The other reason is they bought a clothing outfit, a men's clothing outfit in this compressed margins. And actually the first crack in the stock was for that reason. So even though you may say, wait a minute, profits are going down, it's still $100 million profit. I'm forecasting 500 to 600 million for the year. And that means a relatively low price earnings multiple compared to its history into the S&P 500. So I put the forward PE, it could be as low as 6 versus 14 to 16 on the S&P 500. And if you take a look at Nike and Skechers, now that 6 is an aggressive forecast on my part. Let's say I'm wrong. PE is still going to be 8 or 9. And it's still going to be below Skechers and below Nike. And Skechers has relatively the same operating margins. Nike has a gigantic brand, is considered a safe play in athleisure wear, and it deserves probably a higher multiple. So why did we trade it? Well, take a look. It bottoms out at 47.50, and you would establish a technical pattern here. Excuse me, that it stays here. It doesn't want to go down, goes up, nope, coming down again with the market, nope, and retail data and spending data, but no, 47.50 holds. This is a real sign that we need to do something with the stock, as long as I love the company itself, which I do. So let's get back to what we do. Minimum 0.5% a week. Post-pandemic inflation generated frugality. Seeing sales and market share gains. And the teen thing in particular, number 6 in teen footwear from 38, that's not going away. And the other place, in addition to teens, is look at it in a gym and look at men and women coming off the soccer field and taking their cleats off because it's muddy and they can wash them. Short-term bottom is in place. The chains are liquid and easily exceed that goal. So here's the alert. It went out last week, and it was last week, but we were selling a put that expired this Friday. It's important to keep that in mind. You can read the details. That was the potential return. I knew when this was put on, I had a plan, which was maybe we can close it early. We want to sell something way out of the money, and excuse me, as 47.50, I wanted to get below. I didn't want to go right to 47.50. What if I'm wrong? Want to go considerably below, because this chart tells me if it craters, bulls and bears are going to have an argument at 47.50 for some period of time, unless there's some dramatic news event. And that gives us time to get out. Small loss, break even, or profit. So there's the alert. Excuse me. And then we closed it, and we closed it very early. The alert went on a Tuesday. We closed it on Thursday, and we spent 20 cents. We had a wonderful return. It was about a 1% absolute rate of return. Put up $100, you get $1. Not bad in 3 days. And the annualized basis, for those of you who are familiar, is the way Wall Street measures returns, because Wall Street trades 7 days a week. Japanese government bonds on Saturday, Israeli stocks on Sunday, that kind of thing. And so we do it on an annual basis. So it was clearly a gigantic winner for us. And the lesson, I want you to now go back to the market, is and this is a lesson for you picking your own stocks or evaluating an alert that I send out or asking me questions. Fundamentals drive stock, not trade, stock selection, and charts and the market itself drive trade selection. And it's important to have a feel for or a belief in what you think is going on in the market, which is why I emphasize the market's really cranky right now. It's that nails on a blackboard. It's a dark time in a lot of people's minds, including professional, rational investors and traders. And all of this is, what are your goals? There are people who take the trades in the alert, they do a different strike price, they turn it into a spread, what have you. You have to align what you see from me or whatever else you're doing with your goals. How much cash rate of return do I want? So you should be market neutral in the stock selection. You have to be market sensitive in your trade selection. It's hard. I don't know of any other service that does both. It's not bragging, it's just an observation that it's a totally market neutral approach. It's the real world. It's what I do. I personally believe I do best. And your trade selection has to be charts, liquidity, chains, what's going on in the market. Be ready to close early. And understand that you may accept shares and know yourself, and the two are linked. I know that many people prefer just selling puts, and if I get emails all the time, I can't accept shares, and then I go back, I can't. Well, I'm margined, and if I accept shares, but with puts, I have better margin terms. I can't worry about that here. But be aware that there are times like we did 2 or 3 weeks ago with a bunch of positions that were temporarily or short-term underwater. We accepted shares and we're selling calls and generating large amounts of cash. You have to be aware of that as we go forward. And with that, Emily, I'll turn it back to you if there are any questions.
All right, Michael, Steve says, do you have any insight into why the steady drop in fertilizer stocks like Mosaic and GF has happened over the last several months? Is it something more than just general market recessionary fears?
Well, recessions don't hit agriculture, costs do. And we have a position in Mosaic in the Income Masters program, which is not doing as well as I'd like it to say the least. And what's going on is, let me step back for a second. Ukraine and the Russia, 30% of world grain exports, maybe more, huge. We're already starting to see signs of famine in East Africa because the Russians are blocking any grain from leaving the Black Sea. Well, commercial farmers in the United States, it's probably 95 or 98% of grain volume, maybe more, in large outfits. They forward sell. So they take a look and they forward sell, and their crop is sold, before it starts to rain in the spring. And usually there's a little bit amount of arable land that is marginal that they might put under plow, so to speak, in March and April. This is true in EU. I'd say probably the same in Australia and New Zealand. And no one knew how long Ukraine would last. And so they forward sold most of the crop anyway. So at the same time, fertilizer prices went up dramatically because one of the key inputs, well, first of all, a lot of potash comes from Belarus, embargoed, can't buy it, can't ship it, whatever. And the rest comes from fossil fuels, which spiked in prices. So you put the whole thing together, that is the reason. But then the question is, what will happen is farmers go into harvest and start planning for next year. They'll start doing it and they'll start thinking about it in about 8 weeks, 9 weeks. And so that's the reason. And they are the kind of stocks, they have such large premiums that you have to take a geopolitical view, and that is Ukraine-Russia thing going away? No. Will Russia acquiesce and let grain shipments go through the Black Sea? That's up to Turkey and Russia, not to Ukraine, not anybody else. And who knows? So the bottom line is, I'm expecting within a quarter, you'll probably see again more optimistic within a quarter, maybe sooner, optimistic, because there'll be forward pricing, there'll be futures for next year and wheat and beans and corn, and that'll start lifting fertilizer prices for this reason. When you have higher prices, you more intensively cultivate land. I was in agriculture. I worked in the Midwest and did agricultural work. I was a contractor, but I worked for Purina Agricultural Group for several years. And you can just drive through the Midwest, and if the corn is right up to the road, they're using marginal land in most places. If you see land lying fallow because they're going to plow beans under, or they're going to plow something else under to restore nitrogen or whatever, the bottom line is, that they're not going and they're not trying to get the most out of every single inch of land that they own. And it was obvious that things hadn't changed too much after I put the trade on and I was out there. Long answer, but the dynamics of agriculture is something I'm pretty familiar with. The timing wasn't the best for those of you who took the trade in the master's program.
Great. Enrico says, what indicators do you usually use to place a trade?
Well, as I said, I have a bullpen of stocks. 25, 30, 35 stocks that I really hope to trade for the next 90 days, plus another 25 to 50 that are in the same sectors or best in class. But I may not necessarily trade them because, especially in the summer, in August and July, because of liquidity issues, or there's a major event that makes me nervous, a product announcement or FDA decision or something like that. Short term stock like Crocs, I don't use what they're called the Greeks. I know what they are and I take a look at them, of course, but this is the 30-day chart. I actually look at the 3, 5, and 10-day charts, which tell me where are we going to see money come in. Because money coming in, I know this sounds like an oversimplification, but it's really important because it's worked for almost 11 years. When you know that money is going to come in at this price point, barring some CEO of a company being led away in handcuffs, when you see this, you're going to have time. The stock is going to go down. You're going to want to roll it, don't want to close it with a loss, don't want to take a small profit. And it helps you out. And we have very short-term trades. They're typically 3 to 4 days. Sometimes they're out the 11 days. Once in a while, it'll be a little bit longer than that. And I always, if it's more than a week, I try to close it early. So the indicator is the 3, 5, and the 10-day chart, in addition to where the moving averages are, if I'm doing something more than a week. So this doesn't show, well, this shows the moving averages. It's that little white line. And it's sort of a traditional relationship of the stock movement to moving average. But what you can see this is technical trading. When this is going up, it's good news on retail. You can see the green here is volume coming in that's bullish. This is bullish volume, stock selling at a higher price. And so it's all above the moving average. And yet you can see the volatility of the stock, this red coming down, breaks the moving average pretty sharply on just as green volume diminishes and red comes up. It's just a matter of but you have to be familiar with the chart of an individual stock. This is not the same company by company, but the bottom line is it's the 3, 5, and the 10-day charts drive our weekly put selling. And those are much more important. And I try to sell a strike at and preferably below the previous 30-day low, or sometimes even the 90-day low.
All right, Mike, we don't have any other questions at the moment.
Okay. The weekly update, for those of you who are brand new, we typically record it once a month. We do it live. I think it's very important, if you're brand new, is to please take a look at the training materials so you get your head around what we're doing. It's not what your portfolio is worth at the end of the week. It's not a loss if we roll a position. Okay, if we sell a $20 put and we roll the put because the stock went to 1850, your broker is going to flash red. We only have losses here when we close a position, and we'll take a loss. We admit it, my bad, we move on. And it's the cash rate of return that over time, if we do conservatively, let's say a 20% cash rate of return, that's sort of normal based on history, but with volatility the way it's been, we might be able to potentially do considerably better in the coming months. But that will overcome a downturn in the market. But it's just a matter of, you have to think like an investor and say, General Motors is a really good company. It's just been crushed. The stock's almost been cut in half for no reason. Maybe it ran up too high and it should have been no more than 51. But the bottom line was a lot of stocks have been irrationally sold off. The last thing I'll say is if you're new, we don't do the GameStop junk stuff. We don't do crypto junk. We don't do multiple inverse, this, that, and the other thing, ETFs. And we don't do stocks like Tesla. First of all, it's the price of the stock. We try to keep it under $100 for strike. But Tesla's dependent on the Twitter thumb of Elon Musk. And this is a cash and income generation service. You don't want to go near a company that can, a stock that it was down 7% at the, well, Twitter was down 7% at the open this morning. But the bottom line is there are also certain characteristics of a company and stock that you may love, and it may be hot, and maybe what traders love, huge volatility and so forth and so on. And the best examples of that are stocks that people think are like that, but are not. And that is Pfizer in this service and Moderna in the Income Master service. Pfizer is arguably the cheapest important company in the world. It's doubled its revenues in 3 years. It's using its cash flow. It's made 3 acquisitions or investments that are major. And COVID ain't going away. Moderna is treated almost like a startup, but it has $50 billion in cash flow, $25 billion in cash flow, excuse me. So I look for those as well, where the street thinks they're this trading vehicle and this GameStop thing. It's not. These are fabulous, technology-rich, market-dominating companies. And the street's got it, in my opinion, wrong. And those are also the kind of things we really like to trade. So I'll put out a last call for questions.
Enrico says you haven't traded Starbucks in a while. Is there a reason for that?
Yes, because I've actually started to trade it in the Income Masters program. You'll see me trade it here. When there's a position open in the Masters program, I don't open it here. If there's a position open like Pfizer here, or General Motors or whatever, I avoid it in Income Masters, but we will be trading it again. It's undervalued. For those of you unfamiliar with what's been going on, a few months ago, Howard Schultz, the founder, took over again. And they say that the, excuse me, previous CEO resigned. I think he was given a big push. He was targeting a gigantic stock buyback, and the board and Schultz waved his finger, get out of here. So Schultz came in and immediately the new capital spending plan. And the stock is quite sensitive to lockdowns in China because it's the second largest market. But the American dollar right now is extremely strong, which means their costs for coffee are going down. Now, it's very possible because of shipping issues and in parts of the world, sadly, famine, coffee prices may go up. It's very possible that the East African coffee crop is going to be somewhat ruined. If not, it's going to be hurt pretty badly because of Ukraine. And so I think they're significantly undervalued. Now, they also traded down a bit because of fears of a recession. Starbucks is a recession-proof stock. And actually, people treat themselves to the Venti cappuccino that's $6 rather than spending 12 on lunch. It's an oversimplification, but it's also true. The other thing about Starbucks is the capital spending that they're doing is assuming there's going to be another lockdown and people aren't going back to the office. So I've seen my first Starbucks where you just order and you pick it up. You can't wait there. It's your orders wait. There's nothing else there. There's no chairs, nothing. They're reconfiguring things for drive-through. So they're doing all the right things. And that's why I say you need to think like an investor, and they have very nice premiums. So we will be trading it again in this service and probably pretty soon.
Okay, Marco, that's it for questions.
Well, thank you all. Thank you very much, Emily. Emily, I'll see you tomorrow. Options Income Blueprint, folks. I'll see you tomorrow at 11.
All right. Thanks, Michael. Thanks, everyone, for. Oh, all right. Thanks, Michael. Thanks, everyone, for joining us. We will be emailing you a recording of this session and later today, and we will meet tomorrow, as Michael said, for live trading at 11 a.m. Eastern. Thanks and have a good day trading.